Imagine this. You're staring at your chart, and suddenly you see it. A setup that looks almost perfect. Every candle, every signal, every instinct inside you whispers the same thing. This is the trade. But your trading plan says something different. Not yet. Wait for confirmation. For a brief moment, logic and emotion collide. Then your gut takes over. A rush of adrenaline floods your body. Your heartbeat speeds up. You become convinced that if you don't enter now, you'll miss the opportunity of the day. So you ignore your rules. You click the buy button, and within minutes, everything falls apart. The market moves against you. Your unrealized profit turns into a painful loss. You stare at the screen, wondering how something that felt so certain could go so wrong. If this sounds familiar, you're not alone. In fact, almost every trader has experienced this exact moment. And here's the uncomfortable truth. The biggest enemy in your trading isn't the market. It isn't the strategy. It isn't the broker. It's your own brain. The instincts that helped human beings survive for hundreds of thousands of years are the exact same instincts quietly destroying trading accounts every single day. Your brain was designed to keep you alive, not to make intelligent decisions in a financial market. That's why trading often feels so frustrating. The harder you trust your instincts, the worse your results become. Today, we're going to expose those instincts for what they really are. We'll uncover why your emotions consistently push you toward the worst possible decisions, why your gut feeling cannot be trusted in the markets, and most importantly, how disciplined traders replace emotion with a system that produces consistent results. But before we dive into the psychology behind it, let me tell you about someone we'll call Chris. Chris wasn't inexperienced. He was intelligent, analytical, and had spent months developing a solid trading strategy. He had rules for entries, exits, risk management, and position sizing. For a while, everything was working. He followed his plan with almost robotic discipline. Then, one afternoon, everything changed. A stock that had been falling for days suddenly bounced. It wasn't part of his strategy. There was no confirmation, but his instincts told him something different. This is the bottom. I can feel it. This is where everyone else is afraid to buy. Without thinking twice, Chris abandoned his plan and went all in. For the first 30 minutes, he looked like a genius. The position moved in his favor. His profits grew rapidly. Every second reinforced the dangerous belief that his instincts were right. Then the market did what markets always do. It changed direction. At first, Chris wasn't worried. It's just a pullback, he told himself. It'll come back. His stop loss was hit, so he moved it. Then he removed it completely. He couldn't accept being wrong. He kept waiting, kept hoping, kept believing the market would eventually reward his conviction. It never did. By the end of the trading session, most of his account had disappeared. Chris didn't fail because his strategy was bad. He failed because in one emotional moment, he trusted an instinct that was built for surviving the wilderness, not for surviving the financial markets.
So why does this happen? Why do instincts that serve us so well in everyday life become so destructive the moment real money is on the line? The answer is surprisingly simple. Your brain is running on ancient software. Long before there were stock markets, charts, or trading platforms, your ancestors faced a very different world. Every decision they made was about one thing: survival. Whenever danger appeared, the brain had to react instantly. There wasn't time for careful analysis. There wasn't time to calculate probabilities. The fastest decision was usually the one that kept you alive. That survival system still exists inside your brain today. And the moment you risk your own money, your brain doesn't see a financial transaction. It sees a threat. The same regions of the brain that once protected humans from predators suddenly become active. Your body releases stress hormones. Your emotions become louder than your logic. Instead of thinking like an investor, you begin reacting like a survivor. Many psychologists describe this emotional part of the brain as the chimp brain. It's fast, it's impulsive, it's emotional, and it only cares about one thing: keeping you safe. In everyday life, that's incredibly useful. In the financial markets, it's a disaster, because the market doesn't reward emotional survival, it rewards disciplined execution. Let's start with one of the strongest psychological forces in human behavior: loss aversion. Research has shown that losing $100 hurts far more than gaining $100 feels good. To your brain, losses are far more powerful than gains. That's why accepting a losing trade feels almost unbearable. Instead of closing the position according to your plan, your mind begins negotiating. It'll come back. I'll just wait a little longer. I'll sell once I break even. None of these thoughts come from logic. They come from your brain desperately trying to avoid the emotional pain of admitting you were wrong. The market doesn't care. While you're hoping, the loss continues to grow. Then comes greed. Thousands of years ago, greed actually helped humans survive. If you found food during difficult times, taking as much as possible increased your chances of survival. But in trading, that same instinct becomes incredibly dangerous. A winning position keeps moving higher, and instead of following your exit plan, you start imagining endless profits. You convince yourself that this trade could change everything. You ignore your targets, you ignore your rules, you simply want more. Often that greed transforms into overconfidence. After a few successful trades, you begin believing you've mastered the market. You increase your position size, you take trades that don't meet your criteria, you stop respecting risk, and eventually one bad trade wipes out the profits that took weeks to build. Fear and greed create the most destructive cycle in trading. Fear convinces you to take profits far too early. Greed convinces you to hold losing trades far too long. You end up collecting tiny winners while allowing massive losers to destroy your account. It's the exact opposite of what consistently profitable traders do. And the worst part is, to your emotional brain, this behavior feels completely natural. That's why so many traders spend years searching for the perfect indicator, when the real battle has never been on the chart. It's been inside their own minds.
These instincts don't stay hidden inside your mind. Eventually, they begin controlling your actions, and that's when the real damage begins. It usually starts with something every trader knows: FOMO, the fear of missing out. You're watching a stock explode higher, green candles keep printing, social media is filled with traders posting massive profits. Everyone seems to be making money, except you. Your emotional brain immediately interprets this as danger. If I don't buy now, I'll miss the opportunity. So you abandon your trading plan. You ignore your entry criteria. You convince yourself that chasing the move is better than missing it entirely. And just as you finally enter, the market reverses. The professionals who bought much earlier begin taking profits. The smart money quietly exits, while emotional traders are just getting in. The move you thought was only beginning was already ending. Then comes something even more dangerous: revenge trading. This isn't trading, it's emotional warfare. You take a loss, a perfectly normal loss, but your brain refuses to accept it. It feels cheated. It wants its money back immediately. So instead of waiting for another quality setup, you force one. You double your position size. You abandon risk management. You convince yourself that one big winner will erase the last mistake. But the market doesn't know you're angry. It doesn't care that you're frustrated. It doesn't owe you anything. More often than not, that emotional trade becomes an even bigger loss, then another and another. Before you realize what's happening, a single bad decision has turned into an account-destroying spiral. It's like trying to put out a fire with gasoline. The harder you fight emotionally, the faster everything burns.
But these behaviors aren't random. They're powered by invisible psychological traps that influence every decision you make. The first is called confirmation bias. Once you believe you're right, your brain begins searching for evidence that supports your opinion. You read bullish news if you're long. You ignore bearish signals. You watch analysts who agree with you. You dismiss anyone who doesn't. Without realizing it, you've stopped looking for the truth. You're only looking for reassurance. Then there's recency bias. Your brain naturally assumes that whatever happened recently will continue happening. If a stock has been rising for 3 straight days, you believe tomorrow will probably be another green day. If you've won your last 5 trades, you start believing you've become an exceptional trader. But markets don't reward recent success. They reward consistency over hundreds of trades. Finally, there's hindsight bias. After every trade is over, everything suddenly seems obvious. You tell yourself, I knew that was going to happen. I saw the reversal coming. I should have held longer. I should have exited earlier. But the truth is, you didn't know. You're simply rewriting the past to make yourself feel smarter than you actually were. And that's incredibly dangerous, because if you believe you can predict the market, you'll stop respecting uncertainty. You'll stop respecting probability. You'll stop respecting risk. Every one of these behaviors, chasing trades, revenge trading, moving your stop loss, ignoring opposing evidence, they're all symptoms of the same disease. You're allowing emotion to make financial decisions. You're trading your feelings instead of trading your system. And in the markets, emotions are expensive, very expensive. The market has no sympathy, no mercy, no patience. It punishes emotional decisions with ruthless efficiency. That's why so many traders stay trapped in the same cycle for years, not because they lack intelligence, but because they're fighting the market with instincts that were never designed for it. The good news is that there is a way out, and it begins the moment you stop trusting your instincts and start building a system that thinks for you.
So, how do you escape this cycle? How do you stop your emotions from hijacking every decision you make? The answer isn't another indicator. It isn't another strategy. And it definitely isn't predicting the market more accurately. The solution begins with accepting one uncomfortable truth. You cannot trust your feelings. Not in trading. Not when real money is involved. Successful trading feels unnatural because it forces you to do the exact opposite of what your instincts want. Your instincts tell you to avoid pain. Professional traders accept small losses without hesitation. Your instincts tell you to grab profits before they disappear. Professionals let winning trades develop according to their plan. Your instincts tell you to fight the market. Professionals simply follow their process. That's the difference. The goal isn't to eliminate emotion. That's impossible. The goal is to stop emotion from making decisions. And the only way to do that is to replace instinct with a system. A real trading system isn't a collection of vague ideas. It isn't a checklist you follow when you feel like it. It's a rule book, a mechanical process that leaves as little room as possible for emotion. Before you enter a trade, everything should already be decided. Where you enter, where you exit if you're wrong, where you take profits if you're right, how much you're willing to risk. Nothing changes once the trade begins. No negotiating, no guessing, no hoping. When a setup appears, you ask only one question. Do my rules say yes, or do they say no? That's it. Not what do I feel, not what do I think the market will do next, only did my system generate this trade? If the answer is yes, you execute. If the answer is no, you wait, even if the market takes off without you, because missing a good trade is infinitely better than taking a bad one. This is one of the hardest lessons every trader must learn. Your job is not to predict the future. Your job is to execute your edge again and again and again. Here's something that separates professionals from everyone else. A trade that follows your plan and loses money is still a good trade because you executed your process correctly. But a trade that breaks every rule and somehow makes money is actually a terrible trade. Why? Because it rewards bad behavior. It teaches your brain that ignoring discipline works, and eventually that habit becomes catastrophic. The market doesn't reward luck forever. Eventually, it collects every debt. That's why professionals judge themselves differently. They don't measure success by today's profit. They measure success by today's execution, because profits are unpredictable. Discipline isn't. Once you understand that difference, everything begins to change. You're no longer chasing money, you're mastering a process. And ironically, that's when the money starts taking care of itself.
But even the best trading system isn't enough. Because no matter how well your strategy is designed, you're still human. And humans have bad days. Days when you're tired, days when you're frustrated, days when emotions quietly take control before you even realize it. That's why professional traders don't rely on willpower. They build safeguards, rules that protect them, especially from themselves. One of the most powerful is a daily loss limit. Before the trading day even begins, you decide exactly how much you're willing to lose. Not how much you hope to lose, not how much you think you can recover. A fixed number. And the moment you reach it, you stop. No exceptions. No one last trade. No trying to win it back. You simply close the platform and walk away. It sounds simple, but this single habit has saved countless trading accounts from complete destruction. Because the biggest losses rarely come from one bad trade. They come from the emotional decisions that follow it. Another powerful rule is limiting the number of trades you take each day. The market creates endless opportunities, but not every opportunity belongs to you. Professional traders understand that patience is a position. Sometimes the best trade is no trade at all. Every unnecessary trade increases emotional fatigue. Every impulsive entry slowly chips away at your discipline. The less you trade, the more selective you become. And selective traders usually make better decisions. Then there's one habit that almost every consistently profitable trader shares: keeping a trading journal. Not just recording profits and losses, but recording yourself. Why did you enter? Did the setup truly match your rules? What were you feeling before clicking the button? Were you calm? Confident? Impatient? Afraid? Overconfident after a winning streak? Or desperate after a loss? At first, these notes may seem unimportant, but after 50 or 100 trades, patterns begin to appear. You'll discover that your biggest losses rarely happen because of your strategy. They happen because of your emotions. You'll see that boredom leads to bad trades, overconfidence leads to oversized positions, fear leads to early exits, frustration leads to revenge trading. Your journal becomes something far more valuable than a record of trades. It becomes a mirror, one that reveals the trader you're becoming. Because in the end, trading isn't really a battle against the market. It's a battle against yourself. The charts aren't your greatest challenge. Your emotions are. Your instincts are. Your ego is. The market simply exposes them. The traders who survive aren't the smartest. They aren't the ones with the highest IQ. They're the ones who remain disciplined when everyone else becomes emotional. The ones who follow their rules, especially when they don't feel like it. The ones who understand that consistency is built one decision at a time. Every small loss accepted with discipline, every trade skipped because it didn't meet the rules, every emotional impulse ignored. Those are the moments that quietly build long-term success. Real trading isn't exciting, it isn't dramatic, it isn't about chasing the next big win. It's repetitive, methodical, sometimes even boring, and that's exactly why it works. Because consistency is rarely exciting, but it is incredibly profitable. So the next time your instincts tell you to chase a trade, pause. The next time fear tells you to close a winner too early, pause. The next time greed tells you to remove your stop loss, pause. Ask yourself one simple question. Am I following my emotions or am I following my system? Because that single question may be the difference between becoming another statistic or becoming the trader you've always wanted to be. Stop trusting your instincts. Start trusting your process. Because in the markets, discipline beats intelligence, consistency beats excitement, and systems will always outperform emotions. If you found this video valuable, subscribe to the channel and join a community of traders who believe that mastering psychology is just as important as mastering strategy. And before you go, tell me in the comments which instinct has cost you the most money in your trading journey, because recognizing the problem is the first step towards overcoming it. I'll see you in the next video.